Hello and welcome to the Lolly Investor Programme. I've come to the London Stock Exchange to talk about how stock markets should work. In theory, the stock market is a wonderful money-making proposition. Companies list on the exchange to raise money from investors who buy their shares. If all goes well and the companies are well run, the share prices rise and pay a growing level of dividends that investors can either reinvest to make their money grow faster or take as an income when they retire. The only problem is that the reality often falls well short of the theory. A succession of stock market bubbles and crashes and endless scandals over City Pay make it seem that investment bankers are running away with all the loot while ordinary savers are left with dud investments. In fact, the problems are wider than that. Last week, I talked about how investment bonds were widely sold to the public because they paid more in commission to advisors than other financial products. Some advisors were pumping bonds at their clients because it suited them rather than being in their customers' best interests. And that kind of thing goes on all the time. Fortunately, this may change. This week saw the publication of a really important report by John Kay, Professor at the London School of Economics. Kay was asked by the government to look at the UK stock market and how it helps or hinders long-term planning in this country. Kay's report provides a brilliant analysis of what's gone wrong with financial services in the past 50 years. Kay describes how, as the stock market has grown in complexity, what he calls an equity investment chain has developed. Now, equity is a word for shares, so what Kay is describing is the series of connections between investors and companies. Nowadays, relatively few people own shares directly in companies. Instead, they invest in some kind of fund that buys lots of different shares. This means that companies don't need to bother with individual shareholders as much as they used to. Instead, they focus on the fund managers and a host of city analysts and bankers who represent other big institutional shareholders. The problem is, as the equity chain has stretched and more parties have got involved, ordinary investors have become disengaged with the companies that they invest in. Also, the whole chain has become far too busy. Kay is scathing about how the equity chain has become dominated by a hyperactive culture of trading, selling and chasing short-term profits rather than a more steady process of managing, advising and planning. In other words, the spivs have triumphed over the professionals. The main insight from Kay's report is that the system isn't working for anyone. People aren't saving, the city is held in contempt, and companies don't even use the stock market to raise money anymore. Kay's solution is a system of stewardship in which each party on the investment chain would take their responsibility for the next party seriously and would do what they think is best for the creation of long-term wealth. So, company directors would run their companies according to sensible, strategic business plans. Fund managers would back those companies and not sell their shares if the companies stuck to those plans. And investors would not expect fund managers to deliver top-of-the-table returns every quarter, but would settle for good, long-term returns instead. It's powerful stuff. I really hope the government takes up the recommendations in the Kay report. If they do, it could be an historic chance to turn the theory of a share-only democracy into practice.